All right, so I am recording now. How come my video's not? Oh. When I want to talk about the USB every time,
Yeah,
the happy face, the scared face goes up. Always is looking at you.
good to know.
You know what I'm talking about?
Yeah.
Has like a little O
Yeah.
and two eyes. How come this isn't working? Oh, there it goes. Thank God. All right, there I am. That's what I'm gonna be looking like in a few seconds here. Yeah, you're blurred in the background, so you're good. I do this every Monday. What the heck? This got cut off. Hmm. Never. All right, we've got 6 minutes. Hey, Christy, you on? Best get on. I'll kick your booty. Well, screen went black. I don't know why that happens. Hopefully nobody will come on. That's never happened, but Christy usually sends it out. And she was having a birthday party
So she didn't send it out.
and she didn't send it out. Hello, Christy. Wolf called me.
No.
Yes, I'll give you a call shortly. I'm currently on a Zoom meeting. Can you hear me? Say something again. Valerie, hold on one second. Christy's having some technical difficulties. Hold on one second. Good morning. All right, we're going to start in just 1 minute. All right, well, good morning, everybody. We're going to give it one more minute and then we'll get started here on today's Monday morning mortgage update. Well, welcome everybody, and welcome to today's Monday morning mortgage update. My name is Sean Woolen with the Woolen Mortgage Team here at Waterstone Mortgage, and we've got a lot to go over. We've had quite the ordeal when it comes to the volatility in the markets this last week. This war hasn't done us any favors in regard to mortgage rates. We're going to dive into that in just a second. And we're going to go over some different loan products so you guys can really understand some of the techniques that we have to help you with your sellers in those scenarios where they want to purchase a home prior to selling their current home, and bridge loan secrets and some different strategies on that note. So let's dive right into what's happening. We're going to talk about the loan strategies, the bridge loans at the end. But right now, we're going to get right into the nitty gritty and what's happening with mortgage rates. So we have a big war going on in Iran. It's been pretty volatile because of it. We've seen the stock market get hammered. The biggest issue we have is because of the stoppage of the Strait of Hormuz from the oil delivery, we are seeing potential for a lot of inflation because oil, let's just face it, oil is in everything from plastics to our clothing to our cars, you name it. So we've already seen gas prices rise. That is inflationary long term. So the bond market is not liking that. And the bond market is reacting pretty volatilely to this, which it affects mortgage rates, unfortunately. So we're looking at, we had the lowest rates in 4 years 2 Fridays ago, and now we're back off of those lows. So I always tell this to people, when you're looking to refinance or lock your rate, it may only present itself for one day before going back the other way. But the news will tell you that news for 2 to 3 weeks in a row, even though rates have moved since then. So be careful when you're looking at the rates. We have seen a little bit of spike. So how much is it going to spike? Will it continue? Well, overnight, gas prices reached $120 a barrel. Now, keep in mind, 2 weeks ago, it was in the 60s a barrel. So basically doubled. One of the reasons it got kind of crazy overnight was the son of the Ayatollah has been raised into the leadership point, and he's been looked at as sort of an aggressive, hard line in the sand. He's going to dig his heels in, very similar to his father. And this kind of spooked the markets a little bit. So we'll see how that ends up happening. I'm not going to get into the whole reasons why the Iran thing's happening. I'm just going to look at the effects because that's what I see daily when I try to prepare our buyers for when to lock. But it's going to be an interesting couple weeks. Hopefully, this will end quickly and we can see the inflation fears drop back down and we can see rates drop again. So here's the gas price chart. So we have been in a pretty steady pace for the last couple of years. The gas prices in the low threes, but we dropped down this last year, which has been great. And then look at the spike. I mean, we almost doubled in the price of oil per barrel, and we're up almost 50 cents a gallon in just a couple of days. So it's kind of scary. But this is a temporary spike. It will come back down once things are under normal, or it'll even out. But it is it's going to add pressure inflationary to our markets. So we have to be very cognizant of this and understand what's going to happen next. So it's going to be interesting to see how mortgage rates react. So if you look at the current mortgage rate, Look at that. I don't know why my face is at the bottom there. But here's the mortgage-backed securities. Here's this last week. So if you look at this line right here, this is the Fibonacci level that we've been bouncing against, and we haven't been able to get through this. If we get through this, rates could have gotten better. We tried to get up to it. We tried to get up to it. We tried to get up to it, and now we fell all the way back down here. We almost went all the way down here based on this day when we pierced below this Fibonacci level. Luckily, we didn't, and we bounced above it today, and we're still in this tight trading range. So right now, even though we've seen such volatility in the stock market, today we kind of put our heels in and we stopped losing what we were losing over this last week. Every day last week was rates got worse and worse. Not by a lot, but about a quarter in rate is what we lost last week, which, when you quote a rate up here on a refinance or purchase, and then they go under contract and it's down here, buyers have a hard time understanding this. So I walk them through it and say, okay, we are at a point where we probably don't want to lock because of what happened last week. Looks like we're rebounding, so let's give it some time. Let's not lock in now. If we can gain that back, let's wait. But I will be cautious as we move forward with our customers because a quarter in rate over 30 years is a lot. So we want to be careful with that and make sure we're on the focused on what's going to be best for our borrowers as we move forward. So that's the 30-year. Hopefully we'll rebound above the 10-year. Look at the dramatic move in the 10-year over the last couple months. We were way up here. So we saw a pretty significant drop downward. I'm going to draw this line right here. We saw this drop all the way down, and then last week bounced all the way back up. So notice we went above this and came back down, and we're down here now. So we're kind of evened out a little bit. So hopefully this line in the sand we're drawing right here will hold and we'll come back down because we saw a nice consistent drop in the 10-year. And as the 10-year drops, so do mortgage rates. So this spike was unnecessarily inflicted upon us by something outside of the normal economic boundaries or events. So we have to live with it, but hopefully it'll come back down. So unfortunate, but we were down in the fives on the average for a 30-year fix. Now we're 6.14 as the average. Keep in mind, these scenarios that are being illustrated are based on the perfect scenario. So if you look at the notes, that's 25% loan to value, 780 credit score or better, and no other agency loan level pricing adjustments like second home, condos, manufactured homes. Those are all loan level price adjustments. This is the perfect scenario. So normally your customers will have a little bit higher than this, but this gives you an average. So rates are still great, guys. Still really, really good. So don't panic too much. I just want to optimize rates and get rates as low as possible. And my job is to tell you what's going on in the markets. And we did see a little bit of a spike, but it's not the end of the world because they're still a lot better than they were. So what's going to happen as we move forward? I mean, inflation is the enemy of interest rates. If gasoline prices is going to cause higher inflation, what will that do to the predictions? Let's look at the inflation forecast as we move forward here, because inflation is the enemy of mortgage rates. So the higher the inflation, the higher the rates. But we think this is going to be temporary. The markets are reacting like it's not going to be, but at least in the knee-jerk reaction, but it's flattened out a little bit. So I think they're banking on the fact that this is going to be a short-term inflation piece with the gas prices. So because gas fuel does affect everything. So this is the forecast for what inflation should be. This line in the sand is when this chart was created, but they expected inflation to come down in 2026, which it has, and they think it's going to come down into the 2% range, and that's the forecast. So if rates continue to, or if inflation continues to drop, so will rates. But if you notice that this is pretty flat over the next couple of years, so are the predictions on rates. So let's look to see what's happening with mortgage rates predictions. We were up here back in the day, back in 2025, we were in the high sixes. We came all the way down to the 6.1 level right here. But look at what Fannie Mae, MBA, the Mortgage Bankers Association, and Wells Fargo has all predicted for the next couple years. Pretty much everything status quo, the same. So if you have buyers that are waiting to purchase for rates to come down, they're never going to buy because rates aren't going to go much lower than they are right now. Would there be spikes or like drops and dips down to 5.75, 5.875 for maybe one day at a time? Maybe and probably, but it's not going to stay there very long. So trying to time the market on an interest rate when you're buying a home just is not, it's not smart. Expect rates to be pretty steady, which is a good thing because they've been very volatile for the last 3 years, ranging from 6.25 to 8.5, back and forth like a heart attack on the graphs, right? So now we're looking at a pretty steady course, anywhere from 6 to 6.3 over the next couple of years. It's not what a lot of people want. A lot of people want rates in the threes and fours again. That's just not going to happen unless the government intervenes in a massive way. We don't expect that to happen because that was inflationary. We knew what happened when rates hit 2 and 3. The price of homes skyrocketed, price of everything kind of went up because money was free. They know the dangers of that, so there's no way the rates are going to get to 2 and 3 unless something crazy happens again with our markets. So keep that in mind. Make sure your buyers understand this. And as we move forward, because here's another graph of what the predictions are. Mortgage Bankers Association 6.4, Fannie Mae 6%. Everyone's in the low sixes as far as what they expect mortgage rates to be. So if people are expecting rates in the fours or waiting, the only way to get there is with seller paid buy downs or personally buying down the rate themselves, which is always an option. And I'm fantastic at strategizing with that. So let's talk more about that as we go. So what's going to happen this week? What do we have coming up? Here's a breakdown of the calendar. Today is really a dead day. The only thing happening right now is the war impacting and the price of oil. But we've got tomorrow, we have ADP, jobs numbers, preliminary estimates coming out. They've been relatively weak, which is happening over the last couple months, actually. That makes rates come down. So weak employment equals mortgage rates dropping. So let's hope that's the numbers here are somewhat weak to help us and get rates back down again. We have a treasury note auction tomorrow afternoon. That's a short-term treasury. Then on the 11th, which is Wednesday, we have the CPI. Now, that's inflation report. We'll see how that comes out because it's probably too early to gauge what this gas prices has done to this, but we'll see how the effects are on this. And so that's going to be a big one. Plus, we have a bond auction in the afternoon. Remember, bond auctions, government doesn't have any money. They get it from selling off bonds and taxing us. So anytime there's a bond auction, it's basically the government wanting money by selling these guaranteed returns on these bonds. So anytime there's a bond auction, that's what those are. If nobody wants the bonds, that means that they're demanding a higher rate. That's inflationary. So if these bond auctions go well, mortgage rates can come down. If nobody wants these bond auctions because they don't like the terms, they want a higher rate than what the government was willing to give, that's inflationary. So we watch those very carefully. We have jobless claims initial coming out on Thursday. We have housing starts, building permits, and the long-term bonds on Thursday afternoon. So we'll watch that as well. And then we have PCE, another level of inflation, personal consumption expenditures, and we have the core and GDP coming out as well on Friday. So a big week for inflation and GDP. We'll see if that comes in weak on GDP. That could help the bonds as well and help mortgage rates. So we're going to really be looking at this carefully. Now, for our mortgage product spotlight. So now this has been a very popular topic, the bridge loan. And a traditional bridge loan is actually very expensive. You're doing two loans. You're doing a loan on their current home and pulling out all of the equity they have, not all of it, up to about 80% of it, and doing a very short term, kind of like a hard money loan on the house they're selling. So there's points involved. The terms aren't the best, but it's pulling that money out and using it to buy another house. The great thing about a bridge loan is when you qualify, all of the cost of that borrowing against the house you're leaving behind, none of those payments are counted against you when qualifying. But the fees are very high. So now there's no payments during the bridge loan because, we're rolling those payments into that loan. And that's extra fees as well. So there's other strategies that I want to talk about. We have a product that if the borrowers have their own down payment, where they can put 5% down on the new purchase and then sell that home later, we can do a personal new loan without counting that payment against them. So we exclude the payment on the house they're departing, kind of like a bridge loan does, but we're using their own down payment and we're excluding all of the costs of that other house. That way they can qualify in their own, using their own down payment if they have it. And guess what? If they don't have their own down payment, we can do an in-house home equity line for free. Pull that money out, use that as a home equity line, use that as the down payment, and still exclude all of the payments that you had on the departing home when qualifying. So that way you don't have all of those high costs of the bridge loan. It's a cheap, really simple way that we have internally to do a mini bridge, so to speak, without all of those high fees. You can get the new home, and then once that home is closed, you can sell that other house. Now, if there's a ton of equity in that house that you're selling, and you have a big chunk of change that's coming in, you could then use those funds to do what's called a loan recast. A loan recast is when you put a huge amount, a large amount towards the balance of your loan that you have, and then we restructure it to reflect the new payment based on that lower balance. It's not a refinance. The loan stays the same. We're just adjusting the payment to reflect the new balance. That's called a loan recast. So really cool products, very easy for customers. I'm doing those. I have 2 of them in process right now. Great product for anyone that wants to buy a home now and sell their home later without the high costs of a bridge loan. So a super cool program. And if you're interested in this, let me know. I'll send you some information on it and we can discuss that further in detail. So that's our loan product spotlight. And if you have any questions, you can ask away now, and I'm happy to answer those. So if you have any questions, we do have a chat available, or I'll allow everyone to talk. I'll click on your little thing here so you can all pipe in if you wanted to ask any questions regarding the markets, regarding bridge loans, or any other program for that matter. Any questions? Well, I guess I was such a good teacher that you guys don't have any questions and you're going to go out and crush it with this new knowledge. But if you do, I'm always available. So feel free to reach out anytime. And you have a phenomenal week. And again, if you need me, I'm always just a phone call or a text away. Thanks, guys. Enjoy your week and we'll talk soon.
Thanks, Sean.
You're very welcome.